Welcome everybody to the January IncomePlus Fund webinar. I'm Michael Episcope, co-CEO of Origin. I am here with David Welk today, Managing Director of Acquisitions. And if you are an existing investor, thank you and welcome back. And if you're a prospective investor, welcome and thank you for joining us today. Dave Welk is joining us from our Charlotte office. He was on the last update. I'm sure you remember that if you were here as well. And he will really be a regular host of this webinar going forward. Dave leads our acquisition team, and really what he brings to the table is a boots on the ground perspective, because he's in the field every day and he's got a great pulse on what's happening in the markets. And sometimes, somebody really who Dave Shear and I constantly lean on for market insight. So today I'm going to cover high level fund performance. I'm going to review 2021 and go over a little bit of operational performance. And then I'm going to hand it off to Dave. He's going to talk about portfolio performance, the pipeline, and then go over the state of the market to give you a little bit of insight into what's happening there. And after that, we will, of course, open it up for questions and answers, the Q&A session. So if you please, by all means, put your questions into the Q&A and not the chat box. We will be working from the Q&A box. So, and feel free to enter those questions whenever you have them. A little bit of background just quickly for new investors. Origin exists to help high net worth individuals grow their wealth and generate passive income through real estate. And we have 4 funds we operate today that are designed to deliver anything from growth, so just appreciation, or all the way to income if you are only an income-oriented investor. And the IncomePlus fund really sits in the middle of that risk-return spectrum. Its primary purpose is to deliver a tax-efficient 9 to 11% total annual return, and that's inclusive of both income and appreciation as fund. The fund operates as an open-ended multi-strategy fund, and it builds, buys, and lends to multifamily properties in growth cities around the United States. And we'll talk more about that the portfolio and how that's going in a few minutes. And I would characterize the ground-up development sleeve as something we added last year. It's limited to 20% of the fund's equity, and it's really what I'll call the jet fuel for this fund. So we're excited that that's part of it. Dave's going to talk more about how those development deals are doing in the fund when we get into sort of the valuation performance of deal by deal. So let's jump into the actual, yeah, there we are. Got that up. So this is a snapshot of where we sit today. And this is really as of 12/31. This is updated for the end of the year. The fund's NAV is a little more than $236 million with a unit price of $10.96. And so anybody who's buying in February, we actually have a queue. So the first buy-in won't be until either mid-February with a March 1st trade date or mid-March with an April 1st trade date. But the way it works is that we calculate the unit price for the previous month, and then you buy in at that unit price. So this is really the trade date that's effective as of February 1st. The fund is geographically diversified across 7 states, and the largest concentration is in Texas, but that's really spread even across a few different assets in that market. The portfolio is comprised, it's made up of 42% preferred equity, 24% cash and marketable securities, 28% is in stabilized common equity investments. And then even though the fund is has the ability to put out 20% of the capital into development projects, only 7% is deployed today. So we do have 20% of the fund's capital, so around $45 million earmarked for ground up developments. We just haven't invested the capital into those deals yet, but they have been identified. Common equity leverage, we're only sitting at about 55% today, and we typically target leverage right around 65% of cost, whether we're buying a newer deal, a core plus, a value add, or a ground up development deal. But certainly the appreciation in the market today and our, in the portfolio has resulted in lower leverage than normally what we're targeting. So 55% is about 10% below our target. Now, if you're a current investor, you'll be really happy to hear that 95% of all your distributions you received in 2021 will be tax-free. I just spoke with our controller earlier this week, and we were talking about some of the taxable events that we had and didn't have, and the depreciation and everything. And I think there was some concern about the amount of preferred equity that we have in the fund, and it's the taxable nature of that. So I'm happy to report that, about 95% of all the income will be tax-free. So when you think about, a 6% tax-free distribution yield, that really equates to about a 9 to 10% pre-tax yield. So the fund is doing what it's been designed to do, which is deliver a very tax-efficient income stream. So let's jump into the next slide, and I will cover the 2021 performance. So we had quite a good year here. And what this chart shows really is the historical performance of the fund. And last year at this time, if you remember, the unit price was $9.54, and it has increased to $10.96 since then. So when you add up the appreciation in the unit price and the distribution yield, the total return comes out to around 21% for this past year. The fund, it's also almost doubled in size from $115 million last year. Some of this is obviously through the 21% appreciation, but much of it was also through new capital coming into the fund over the last year. And I'm happy to report that the fund has paid out dividends every month since inception at a rate of 5 cents per unit. So the distribution yield right now is 5.7%, and our target is anywhere between 5 to 7%. Now, I do have an announcement, and we haven't sent anything out on this yet, but we are increasing the distribution yield by 5%. So historically, we paid out 5 cents per unit, and that will be increasing to 0.0525. So the yield's going to get now closer to 6%. And our goal is to increase the dividend every single year. So I wanted to share this good news. We've had quite a great year, and all signs really point to real estate continuing on an upward trajectory in 2022. And Dave Welk will highlight that a little bit more when he talks about the state of the market. Let me finish up. I have really 2 more things to cover. I'm going to go over the operational highlights next. You can jump to that slide. Thank you. And then just talk about some nuances of the fund. So what you see in front of you is the common equity only. This is a 14-month snapshot. The blue line is occupancy and the orange line is revenue. So obviously, whenever you have a chart that's going from, the bottom left to the upper right, that's a good looking chart, especially in the financial world. And so you're seeing this trend really across the nation. We are seeing strength in every market because of the undersupply of housing and some of the just COVID effects, the demographic changes in our markets. Our occupancy today is almost 95%, and that's 90, versus 90% 14 months ago. So a substantial recovery, certainly in our portfolio. And really what's important about 95% is it's sort of that magical occupancy where you can really start pushing rental increases when you get to this level. You don't want to run a portfolio at 99% because it means you're not charging enough, and you certainly don't want to be at 90% because you're leaving, you're just not maximizing revenue. So 95%, we're going to really start seeing the rental increases, and you kind of see that in the orange line, just the revenue continually increase. Now, the dip you see at the upper right on the blue line is a little bit of seasonality, nothing to be concerned about there. Leasing typically slows down almost in all markets around October and November. But you can also see that our revenue has steadily advanced over the last 14 months. And some of that is a result of, just not only strength in the market and more occupancy, but renting at higher rates. So concessions have largely disappeared from the market. So where we were giving away a month, even a month and a half a year ago, we're not doing that today. So the revenue line, especially in our portfolio, it'll continue to increase as we roll off some of those leases where we had to give away the free rent. So the last thing I'm going to touch on is the question that we got before we got a lot of questions emailed in. But there's one that I want to touch on here in particular. How is the dividend paid? And there are really 2 ways to pay a dividend. You can pay it from current cash flow. and or you can borrow against future earnings. And all companies really utilize these two methods. I'll say healthy companies. When you're looking at the Income Plus fund, the most important thing to evaluate or view is the distribution yield in concert with the unit price. The unit price itself captures the balance sheet of the Income Plus fund. And whenever you're looking at a company, it's important to look at both the income statement and the balance sheet. If you're looking at one without the other, you're not getting the full story. And so what we have been able to do is consistently grow the balance sheet of the company, the Income Plus fund, while also making regular distributions. Now, there are going to be times when our current cash flow of our assets, they don't wholly cover the distribution yield. And when that happens, if that happens, then we simply borrow against future income. Now, keep in mind that part of our cash flow is the repayment of preferred equity. And we're going to have more than $80 million in preferred equity that's going to be paid out at some point this year. So all debt is future income brought forward. And we as managers have to just constantly manage the distribution yield, current cash and things. So really what I want to say is paying the distribution yield, it's not a problem based on, when we're evaluating the payoff of preferred equity deals and also current income and then cash on hand. And the other thing that has to be measured really is the total liability. And I think when people think about the 6%, they look at the full $236 million, but it's not that simple because 60% of our investment partners, they opt into the dividend reinvestment plan. They want accrual and compounding investments. They want a growth type of investments. And so you don't do that with a portfolio of purely cash flowing assets. Well, the other 40%, they want income, right? So we as managers really have to manage our investments to meet the needs of both types of investors. And when you do the math, the 40% who want income, it means that at $236 million, our monthly cash obligation is only around $472,000. And so it's really a balancing act because we have to have that mix of assets at all times. And we're going to be out of balance at any one time, but we have the ability to borrow against our cash reserves. And that really solves the problem, both near term and long term for us. So I wanted to answer that question. It's one that's come up before. I know our IR team has gotten that question as well. And if you have any more questions about that, feel free to put it in the Q&A or email us offline. So Dave, over to you.
Thank you, Michael. Good afternoon, all. And I think last time I was on, I had some issues with the feedback in my ear. And my current challenge today is the challenges of working in WeWork and paper thin walls. And my neighbor is on some calls right now and told me that if he's too loud to bang on his window. So Michael, if you could let me know if you're getting a bunch of feedback from his voice, please feel free to give me a little nudge as well. But let's jump right into the portfolio highlights. Afterwards, as Michael mentioned, I'm going to provide a brief overview of our current acquisition pipeline for our various fund investment opportunities, which, as we'll talk about later, includes about $106 million of potential equity deployment across 12 different investments. And we'll finish up with a quick state of the market. We come up with a couple, actually 3 different talking points, but we'll feel free to use the Q&A as a open forum for anything else that on state of the market if folks have questions. But we're going to cover interest rates, construction costs, and supply and demand. But first, to talk about the assets in our common equity portfolio. So again, these differentiate what these are. These are common equity investments that are different from a number of preferred equity investments that we have in the portfolio that are operating assets, and they fully enjoyed some of the depreciation benefits that Michael mentioned, as well as some of the continued valuation benefits that exist currently in the market, which we will cover some of those elements really at the end of the presentation as well. So first off, it's Monroe at Aberdeen. The property here is enjoying a significant recovery operationally, along with the corresponding West Loop submarket here in Chicago. as evidenced by the fact that we've been able to implement in additional revenue generating initiatives, including charging for parking. And we're also creating additional value here on a monthly basis by defeasance of the existing loan, and we can explain in more detail what that is. But basically, we have the ability to refinance this project at a lower interest rate in the future, a more attractive interest rate, and every single month that we get closer to our loan maturity, it costs us less to repay that loan early. And currently, and of most note, this project was plagued with a lot of the other submarket assets in West Loop in Chicago with a significant concessionary environment in February or during COVID, where at peak, our project, along with a lot of the other projects in the submarket, were offering up to 3 months free for new leases that were signed at the height of COVID. Currently, we're offering concessions of about 1 month free for any leases that are signed prior to February of 22. So that's a significant increase to our overall collection revenues at the property. Simply put, 1 month of collections is about, or of rent, free rent is about 8% of your total annual rent collection for the year. So 16% increase in collections by just moving concessions down alone from 3 months free to 1. Over the quarter, we averaged about 94% occupancy, just slightly ahead of our competitors in the market. And a couple of other stats that I think are great to point out. During the quarter, we retained 54% of our expiring leases. We bested our competition in that regard, which was about 47%. And what is important to note here is that we increased average rents on renewing leases by 10%. So it was a significant increase while retaining a number of expiring tenants as well. Even more important than that, we've been continuing to drive rent growth here with new leases, again, outpacing our competition by growing rents on new leases, which is different than obviously your renewing tenants, your expiring tenants, posted a 16% increase quarter over quarter as compared with 9% in our competitors. So we're really starting to take some good wins on this project, and a lot of intensive investment management, asset management practices really starting to beat out our competition. Madison and Westinghouse are probably the most fun to talk about because frankly, it has been our strongest performer and by a decent margin in the fund. And it continues to, this north suburban Austin submarket continues to blow the doors off in terms of its fundamentals. And again, similar to Monroe and Aberdeen, we're having really strong results even compared to our competitors within the market. So a couple stats on this one: averaged about 96% occupancy for the quarter. We're about 1.5 points above our competition, which was around 94.5%. Here's an interesting stat: our average rent increases for the quarter were 21% compared to our competition at 9%. I mean, and this is coming off the heels of a really strong Q3. So we've seen dramatic rent growth at this asset, and has really been a benefit from broader immigration trends from COVID that we're seeing not only in Austin, but frankly in most of our Sunbelt markets. So we continue to just really pop on our increases here for renewals quarter over quarter. We do have some headwinds that we'll be contending with over the course of this year. There's 6 multifamily projects totaling about 1,700 units that are currently under construction within a couple miles of our project. Most, if not all, those are scheduled to deliver over the course of this year. So we're going to have to implement some defensive measures to continue with some of our robust rent gains, because a lot of this competition obviously is going to come with new bells and whistles, modern state-of-the-art finishes. And we will be spending capital defensively to keep pace with them, or I guess maybe offensively, depending on how you look at it. So we'll be implementing some smart home technologies in these units, smart door locks and thermostats to differentiate some of our newer built competition. And we are also installing 4 electronic vehicle charging stations at the project as well. So making sure we're capturing the electric vehicle users at the project, which is given the presence of Tesla in Austin is a growing number in our tenant base across the board. As I mentioned before, this continues to be the strongest performer in the fund. As Michael alluded earlier in the presentation, we've seen significant write-ups from our acquisition basis on this project. On District of Memorial, this asset continues to help give us some non-geographic, or provide some geographic non-correlation with the balance of the portfolio, even with Austin, another Texas-based asset, because of its location in Houston, which is continually reliant on the energy sector. That segment has continued to recover solidly. And when we acquired this project, oil pricing was bottoming out, and it's now approaching, or was, and kind of bounced around $90 a barrel. And our operational performance has followed suit with the recovery in the energy industry. And in Q4, we maintained an average occupancy of about 94% of the period, which is about 1% higher than our competition. This was a slight dip from where we ended out the prior quarter, which is about 95% occupancy, but we knew we were going to trade off a little bit of occupancy for rent growth. And we'll talk about that here in a second, but we achieved that. So we were able to really aggressively push rents at this project to the tune of about 10%, an increase in effective rents over the quarter. Again, outpacing our competition, which achieved about a 7% rent growth for the quarter as well. So we definitely won. We traded a point of occupancy for 10% increase in effective rents there. We do have some exciting enhancements that are being made to the club room right now on the leasing office, which will begin in the second quarter of this year. And we're showcasing those marketing and renderings with new leasing prospects as they complete their tours of the project. Just a couple of high-level macro announcements for Houston, but they continue to have a number of solid job announcements, and that's true of most of our markets. But just to note a couple in Houston, UPS and Amazon both announced a plan to hire additional 6,200 employees throughout Houston. You've got a very strong for-sale housing market that's up 11%. And submarket occupancy has achieved its highest occupancy here in the Memorial submarket since 1998. So we're going to see continued strong demand for apartments, especially here in the Class A space. And that's really a broader macro story. And we talk about some of the fundamentals that exist now with lack of available inventory for sale housing. Prices really escalating there, and if interest rates go up, it makes obtaining housing more affordable, which frankly should push demand across the board for our rental assets. Next, we'll jump into the development portfolio here. We'll talk a little bit about each one of these in detail, but our first build for rent, our build to core asset, which Michael said or mentioned earlier that we've got a 20% allocation toward. The Charlotte Avenue was our first that we broke ground in towards the middle or latter part of last year. This is a Class A project located about 5 to 10 minutes from downtown Nashville. Great location along the high growth thoroughfare of Charlotte Avenue, hence the name. Location has got great access to I-40. Ton of growth that's being here in the urban suburban character. It's got a lot of new trendy retail developments in close proximity, a lot of townhomes that are going up here and single family homes. So the area is definitely, it's way past gentrification at this point. It has become a very in-demand location within Nashville. As a whole, project's going to have sub-market leading amenities. We're going to have a large courtyard here with a pool, a 2-story fitness center, a theater, and co-working facilities here, which has become more in demand, obviously from work from home here in COVID, and we're looking at implementing co-working strategies, frankly, in all of our new projects and existing where we can. Since we broke ground on the project, land pricing in the submarket, which is true of, frankly, most of our markets, is up dramatically. And then comparable trades are being executed in the market today, well above our underwritten exits in years 3 and 5. So we feel quite good about our development basis and our pro forma here, and the prospects going forward. Just a quick update on kind of where the project stands in terms of development progress. We're doing a lot of work on the site, on just the site itself, which is nearing completion. So we're completing the retaining walls, below grade stormwater, site utilities. So a lot of the stuff that goes underground, which is not interesting, but critical, is being done. And then, you know, like of all other projects, once you start framing and the foundations laid, we'll start to see some, you know, the project really take shape. But there is an update here in terms of schedule. Nashville as a market, much like I live here in Charlotte, we saw very similar trends. Nashville is certainly more outsized in terms of inclement weather this winter. We've now had 45 rain days filed against the project since we broke ground. So that's putting us a little behind schedule at this point. If we're roughly, depending on the week, about 6 weeks. We have the ability to make up for those days as we commence construction, implement double crews on the weekends. And so we think that there's opportunity to catch up, to kind of gap up the schedule in terms of where we're at on the back end of the project timeline. On Linden House, we closed on this asset in September. This is a 295 unit, 4-story project about 25 miles southeast of downtown Jacksonville. This marks our first entrance into Jacksonville, which is a market which we'll talk about here in a second in terms of just overall fundamentals, but has been super strong in terms of rent growth. And also in terms of land appreciation as well. The project itself sits in Bartram Park, which is a 5,000 acre mixed use site and near Ponte Vedra. For you golfers out there, you might know of Ponte Vedra, the PGA Hall of Fame and the 5th major. But this has great access to I-96 and the Nocatee Parkway, so you can really kind of get throughout the Jacksonville MSA pretty conveniently from this location. Our partner on this project is Jacksonville-based Rise, who's also our partner on the Horizon Sereno project at the bottom of the list. They're a vertically integrated developer, contractor, manager as well of multifamily communities throughout the Southeast. They've been in business for 26 years, and we couldn't be more excited, frankly, about the partnership so far, noting that this project remains on time and on budget. I could give you a little bit more intel on the specifics of the project, but it's I think the coolest thing to take away here is that this is going to be a golf cart community that you'll have ability to, same with frankly the Horizon project, where you'll be able to jump on your golf cart and access a lot of the surrounding retail development here. But very excited for this project to be underway. Belmont is particularly near and dear to my heart. I spent a great part of 2021 getting this project off the ground. Proud to note that we officially broke ground in November. We're partnering with Atlanta-based and Miami-based Kaplan Residential, who spent over 2 years entitling the project, which really speaks to the barriers to entry that exist in this location within suburban Charlotte. We started what is a significant amount of site work in November. I was out there a couple of weeks ago for the ceremonial groundbreaking to throw the hard hat on and dig a shovel in the dirt. And for those of you who've not been to Charlotte previously, we're notorious for our clay soils here, and it literally looked like the Martian surface in terms of the amount of earthwork that's going on there. It was pretty cool to see. But we're underway there. We anticipate our vertical construction contractor to be on site once all the earthwork is done in July or August of this year, and total timeline for construction on that project, which will be about 322 units in total. We anticipate that being about a 30-month timeline. Lastly, as I mentioned before, Horizon is a project that we are partnering with Rise on as well. This project's located in Tampa. It's about 28 miles southeast of downtown Tampa if you're looking for the location. This finishes here will be absolutely Class A in every aspect of it. And I mentioned before the golf cart aspect of it. The residents can access by the nearby retail, which is very Florida of this opportunity. So we'll be able to attract a number or a wide array of demographics between young and old alike. Construction time here is also anticipated around 18 months and benefits from its proximity within the greater Sun City development. Quick note on this chart here, we talk about the expected value at stabilization. Since this is an open-ended fund, we've developed a methodology for valuing our development projects and then writing them up along the life cycle, depending on where they're at in the development process. And we can certainly go into more detail on the methodology there, but trying to put it in simple terms, basically we're using a discounted cash flow model approach, and then we segment the discount rate based on where the project sits in terms of its corresponding point of construction. So, and then we have a spread over the corresponding discount rate for stabilized deals in the market, which that spread declines over time as you make it through the different phases of development. So for example, the spread is at its widest, when you've broken ground, and then the spread decreases in the discounted value approach that we're using once you hit 50% of construction, then you hit certificate of occupancy, and then you lease up. So that's how we arrive at those the values, expected values of stabilization. Next slide, we'll cover the preferred equity portfolio. I'll be taking a high-level approach here in terms of updates, similar to what we did last time. What I'm most excited about here is that this slide is significantly longer than what it was last update. We added 4 new investments to this, so totaling 11, which includes actually pulling off Star Metals, which paid off over the quarter as well. So December was a really busy month for us. Very proud of our team and the production that we had going into year end. We closed $60 million across 4 deals. The bottom 4 deals on the screen, most of those were closed in December. So busy quarter for us, and a lot of new quality prep deals that were added to the portfolio over the quarter. So if you look at high level, the annual yields and coupons that are shown, and you compare that with some of the earlier deals that were completed in the fund, and I'll point out Aspire and some of the Greenville opportunities that folks who've been on prior webinars have heard me talk about. Those coupons or yields, we call them, annual yields were about 13%. And the market has continued to tighten. We've seen more and more capital flow, not only into preferred equity, but frankly across the board in all assets or all risk profiles of multifamily. So what that capital does is it compresses down the yields that we can obtain in the market. So as you see, if you look towards the bottom, you can see that those yields are compressing closer to 11% to 12% in some cases on the high end for new investments that were being made. We expect this trend to continue, and I'll caveat if we see a significant uptick in interest rates, that actually could widen out to our benefit. We might be able to start charging more on those return or on those yields, but right now, all things being equal, we're seeing a lot of capital that wants to continue to pile into the marketplace, and we believe that those yields will continue to compress, somewhere in that low double-digit range. We can't really go below 11% just given our hit our target cost of capital, so we're having to be very selective, very innovative in how we source deals. A lot of our deals are through existing relationships, off-market opportunities. And we've built a couple of strategic relationships with developers where we think we're going to have a significant number of opportunities that we'll be able to replicate over the course of this year. So the one other thing I want to point out from this slide, there's a lot of numbers to look at, but is the Kingston Point project in Chicago that we closed, which if you look at it as a number, 11%, it's our lowest yield in the portfolio. But it's important to note a couple things on that. Number one, that pays a 5% current dividend yield, which is very attractive for the fund, helps us pay correspondingly our dividend yield because it's an operating asset. And then number two, our loan to cost on that opportunity or that investment is about 81%. And most of our other projects were roughly in that 85% range, plus or minus, on the loan to cost. So while on the surface it looks like a lower yield, where there's some components to it that actually we like quite a bit. Most notably, our partner on the deal is probably our most prolific partner to date, Chicago-based firm that I think this marks our maybe 7th deal that we've done with them. So a lot to like. It is a smaller investment too. It's a little less than $6 million. So we compare that total equity to, for example, the Novi Concord deal here in Charlotte that I closed, which was $21 million, or the Goodwin, which was also $21 million in Austin as well. When you compare that as a percentage basis of the capital we put out, we're certainly getting some higher yields elsewhere. So lastly, just to give folks some color on how we structure our preferred equity. Generally, in every case, we've been able to maintain what's known as a multiple floor in the market, which sometimes can be known in the mezz world as minimum interest. But basically what it does is it guarantees us that we're going to get a minimum amount of return, irrespective of the time and duration that our money is out. And that's important characteristic to understand because of where we're at in the market. And we're seeing a lot of developers take advantage of unprecedented pricing in the market for pre-sale opportunities. And pre-sale opportunities are certainly become the execution of the day, and forward commitments, as they're called in some cases, are certainly the soup du jour. And so you're seeing a lot of developers selling their projects now, not only before they've been fully leased and stabilized, but in some cases before they're even built. So you're seeing acquisition groups who are so starved for opportunities, they're coming in, projects that are 7-8 months under construction, where you're maybe just starting to go vertical. They're taking on, the balance of some cases they may not take the full construction risk themselves. They're certainly taking the full lease up and risk, and they're putting up capital to secure their investment way before the project closes, and ultimately they can start taking over on leasing. So it's pretty wild time in the market, but what that does for our pref positions, if a developer decides to take advantage of the market and sell, and we don't think that we underwritten the deal to be a 3 or 4 year investment, that multiple floor guarantees us that we're going to get a higher rate of return. So for example, a 1.3 multiple floor, simply put, it's roughly almost a guaranteed 30% return. So we're starting to see a few of these hit, and they produce really high IRRs for the fund. The challenge is that we have to go backfill, and we have to make sure we have a deep pipeline of opportunities as those pay off. And as we note here in the pipeline, you can see we've got a lot of activity. So one last thing to note on this slide is there's a number of, as I mentioned, 12 deals on the pipeline. We are starting to, and I think Michael did mention this in a prior webinar, and Dave, on both for Growth Fund 4, and also I think in our prior webinar here. But what we're going to be doing strategically for this fund, which is frankly a real benefit for both this fund and for Growth Fund 4, is that a number of these opportunities in our pipeline are going to be investments that are made on behalf of IncomePlus Fund into Growth Fund 4 investments. And we like that for a host of reasons, but most notably as a benefit for both funds. For IncomePlus in particular, what this does is it gives us a lot more visibility into the common equity ownership, because we are sitting on both sides of the ledger, as opposed to partnering with true third-party common equity, where they have more control rights than we would normally have access to. So we certainly like having commonality in terms of both sides of sitting in both tranches of the equity stack. But we're getting, most importantly, we're actually lowering the loan to cost for this fund, because we can control how high we go in the stack. So we're actually able to achieve a similar coupon at 85% of the cost that we're doing in third-party deals, at only going up to 75%. So we're getting, great returns for the fund, taking on lower risk, have a known entity who's sitting with us in the equity stack. And ultimately what that does for Growth Fund 4, back to Michael's term in terms of supercharging the development deals for this fund, what this does, this lower cost of capital supercharges the returns for Growth Fund 4 investors. So we think it's a great, we talked about this for a long time in other funds, and we were trying to figure out a way to make it work. And frankly, I'm excited. This is a great development for this fund and for our investors, because we know the deals inside and out. We're obviously choosing to do them as common, love them as pref at 75%. So overall, portfolio continues to do well. As I mentioned, we might see a few more payoffs for this over the coming year. So we'll continue to backfill those with a growing pipeline. All right, I think we'll jump to state of the market here, and how are we doing on time? I think we're doing okay. All right, so I'll try and through these quickly so that we give plenty of time. I know there a lot of questions came in before, and we'll probably get a few that are stacking up in the Q&A as well. So I'll cover interest rates here, and we could certainly go deep and down some rabbit holes, and I'll try and avoid that. And haven't fully consulted with our house view internally on how we view interest rates. So some of this is a little off the cuff and personal commentary here, but we're prepared for the Fed to begin raising at least one or a couple, maybe two hikes as early as maybe next month, but probably at the March meeting over the course of the year. Has to be done in my view, and I think of the view of several others, really to kind of stem the rising tide of inflation, this transitory nature of it that's been discussed. I think it's pretty permanent right now. 7% CPI year over year is real. We'll talk about construction costs here next, but we're definitely seeing that spill over into construction pricing as well. So I would expect to see interest rates move a little bit. I don't think we're going to see $1 or percent per percent in lockstep increase with increase in the Fed funds rate and the 10-year, for example. So I think the bottom line is that there's so much capital out there, and I'll share with you anecdotally. Our team was down in Orlando last week for the National Multi-Housing Conference, which is a gathering usually in a non-COVID world of, I think the peak is normally about 12 to 14,000 people. This year with Omicron raging, I think we had roughly 8,000 folks in Orlando, but it's a consortium of developers and owners, fund managers, brokers, really the whole industry. And what I always take away from that meeting is I try and get what's kind of the pulse of the market. And that in my mind was the takeaway from it, was that there is a wall of capital that still remains in the marketplace to be investing in U.S., mostly Sunbelt multifamily, but frankly across the board. And to put some numbers on it, I don't have the specific numbers of dry powder, how much exists out there, but well into the hundreds of billions of capital that's been raised to be deployed into multifamily real estate. Most folks who had a record acquisition year last year expect to double or triple their volume in acquisitions for multifamily this year. So while we may see increases in the funds rate, corresponding increases in the treasury, the capital is still looking for a home. And if you want to go fight inflation, you want to be in real assets that produce yield. If you're in fixed income, for example, and you're trying to invest in the Treasury, and say you go from a 1.75 on the 10-year to 2.5, for example. Well, you picked up 75 basis points of additional yield premium, but in a market with 7% CPI, if that continues next year, you're losing. You're still not even getting, you're not even keeping up with cost of inflation. So being in risk assets, being in hard assets, I believe is still where folks want to be. I think that's really going to keep pricing in check for the course of this year. I'll talk about construction costs again here in a second, but for those of you who joined in the last one, I was complaining about it then, and I'm going to complain about it even more now. We're seeing, last time it was lumber, and just we were fighting off engineered trusses as being a huge increase, tripled in cost year over year for basically creating the roofs and the floor trusses. Now we're seeing roofing systems themselves, take a year lead time to be delivered. But now it's every division of a construction contract. It's the electrical contracts, it's the laborers for the electrician, it's copper wiring that goes in the apartment contract or project. So it is across the board. And what we're trying to do is flesh out how much is this still related to the overhang of COVID. This Omicron surge appears to have really affected lumber pricing again, but that's really more folks that were working at the mills who got it. We heard about this in the last go around that, the mill workers, a lot of them were, kind of banding together to get it so they could get, some leave away from the mill. Some of that's truth, some of that's rumors, but ultimately, we believe that that deliveries are going to be back to where they were at in the fall before Omicron surge, and we do believe in the market. A lot of the market folks do believe that pricing is going to come back down for lumber soon, in the next quarter or so. Once we've got the mills are back and running, there's always a lag in the pricing, and we think that we'll see that here shortly. But global supply chains issues remain real. I haven't checked in on the live webcam from the Port of LA recently to see how many barges are sitting in the port, but my guess is that we still have a few out there. I actually got to see it in October firsthand when I was in California. And I think the supply chain issues, there's still the overhang related to some of the more aggressive COVID policies that from other countries. And we also have heard this from resin suppliers that part of the issue is that not just COVID, but China's shutting down manufacturing. They were leading into the Winter Olympics to improve air quality so that they can put on the best show they can on a global stage. So these are all things that are feeding into the continued challenges, and to kind of put a bow on it. Annual increases were up 6% or more last year. I wouldn't be surprised to see another 4 to 7%, upwards of maybe 10% this year as well. But as we talked about, these increases in costs actually are not even keeping our rent growth in our markets outstripping those increases in costs. And I gave an example in the last webinar, and I'll do it again because it's powerful. But a $20 increase on a $1,400 rent is about a 1.4 increase, from the prior rent. And we're seeing 10 to 25%, as I mentioned, in most cases, 25% growth. And we believe that'll cool. But so think about that: $20 increase and $1,400 rents is 1.4% growth. That $20 rent increase can absorb $2 million in increases when you're capitalizing at a 4% cap rate. And it's crazy to think that a lot of what we heard at NMHC for the first time ever in the Sun Belt, sub 3% cap rates. We're 2.6, 2.8. How far do we go? We don't know. But so I'm using a 4% cap rate to grow at a 25 multiplier. So anyway, what we're saying, a long way of saying, is that if rents are growing at 20 to 25%, and you capitalize that, you can cover a lot of overage pretty quickly on your average $70 million project. So the math is still working. Will that work? There will reach a point of resistance where rent growth will cool, and it will likely this year. It may not be 20, but it may not be 0 or 3, somewhere in the middle. But then once that cools, these increases in costs are going to have to be tempered as well, because capital just can't continue to take it, right? Frankly, they still need to earn a rate of return. So that's it. In terms of supply and demand, which is our last bullet, I'll try and finish this up quickly here. We are still way short in terms of producing housing units in this country. We've been 600,000 units shy for over a decade, and we will continue to potentially be shy in producing units if pricing continues to go up the way it does. That will quell some of the starts, and I think it creates more of a challenge as well. Affordability, I think, will keep rental fundamentals strong. 45% of the population can't afford to buy a single family home if rates go up. You know, we have limited supply. Again, the circle continues. So for the most part, supply and demand remains very much in balance, and I would say actually favors developers and owners term for multifamily. Right now, we still have some real headwinds to actually getting supply out of the ground, which should bode well, frankly, again, for owners of assets. So, Michael, I don't have any wind left to take out of the room, so I'm going to kick it back to you.
All right, I will take over. And we are going to move to the questions that were emailed in through the registration process, and I'll jump into those right now, and then we'll get to the ones that have been asked in the Q&A box. So Dave, if you want to start looking at the ones in the Q&A box and just kind of teeing some of those up, and I might ask you a question here too, but I want to take care of some of these. Most of them got answered during the presentation, but I'll just start at the top. Any plans to close the fund in the foreseeable future? The answer is no. The IncomePlus fund is built as an evergreen fund. And the fact that it's multi-strategy, we have this development component where we can continue to take 20% of the fund's equity, put it into development. It's that rocket fuel, the jet fuel for the fund. And also the other component is the preferred equity side, right? That requires a constant acquisition pipeline for those new deals as they pay off. And really what the common equity does, or the more stabilized, the core plus deals, they provide the necessary depreciation to keep this fund tax efficient. So it's really the combination. There was a lot of thought that went into how to design the fund, what strategies, but overall, it gives us the opportunity to be dynamic across cycles, and either way more towards pref if we want to be protective, or way more towards common equity stabilized deal if we think that deals are underpriced. But I think development will always be a component of the fund, just that higher risk, higher return element to it. And if you look at where we are today, we're at just under $240 million. And Blackstone, the B REIT has a perpetual life as well. It's open-ended, and there's somewhere around $50 billion. So there's a big gap between there. But right now, as we see it, we still have the team and the ability to execute on our strategy here and deliver the returns, those 9 to 11% for quite a while. The next question is really about tax efficiency. Is there a REIT? And how do K1s work? There is a REIT blocker in this. You will be investing through an LLC, so you will get one K1. But what that REIT does is it creates tax efficiency underneath the actual LLC itself, so that all of the depreciation really goes up to the REIT itself. And then if we have any taxable income, it gets caught there, and then we can distribute that to investors on really a tax-free basis going forward. And it also helps if you're investing through a self-directed IRA. It takes care of UBIT or any of that nature if you're investing as a non-taxable entity as well. So you're not going to have multiple K1s, but you will have one K1 because the REIT takes care of that. So Dave, hopefully you caught your breath by now. I'm going to ask you a question here. How are investors protected during any impending recession, given that interest rate rises may cause recession?
Good question. I would say that interest rate rises could cause recessions, right? There's always a risk of that. But I think generally speaking, recessions are not only interest rate driven. What I mentioned earlier about the benefit of being in hard assets, right, is we have yield and we have the ability to, generate additional cash flow and really cover the interest rate risks that we have. It's probably a good opportunity to talk about, we do have some hedging strategies that we're implementing on behalf of the fund. And we will be implementing that first with assets like Morris and Belmont. We'll be executing hedging instruments there so that we can hedge away interest rate risk. We also can hedge that away with fixed rate debt, which is the case of Monroe and Aberdeen. So we have fixed rate debt on that particular project. What's interesting about rising rates in that asset, so we mentioned before that Monroe and Aberdeen has been benefiting from that defeasance, right? As we get closer to the maturity, the cost of defeasance goes up. Well, that cost goes down way faster if interest rates get closer to the underlying interest rate that we're paying on the project. So in some cases, it actually helps with that particular asset. So we have different strategies to benefit in terms of fixing our debt, removing some of that interest rate risk. I'm not really concerned at a macro level that we're going to see rates rise to the point where we're at record debt service coverage and debt yields that we've ever had. We can withstand quite a bit of shock of rise in rates. And we maintain a very moderate level of leverage at the portfolio level. So we're averaging, 60, 65% on our stabilized assets, very moderate level that, it puts us in a good position to weather the storm.
Next question, I'll take it. How are you sourcing deals that have sufficient yield and a low cap rate environment? Great question. And if you've been on the previous webinars or really any of them, you've probably heard us say we're really embarking on a barbell approach. So we're not doing anything in the middle where we're buying existing value add deals. We're not buying core plus. We're not buying any stabilized deals whatsoever. We are putting money primarily into preferred equity on that side of the equation, and then ground up development. And the ground up development is a build to core. So the idea is that we're building to a much higher cap rate in the future to be able to generate more yield, because today cap rates are, pick it anywhere from 4 to 3.25, depending on the markets. It's kind of crazy, and it's very difficult to generate yield in multifamily in these markets. But the way that we're really doing this is the preferred equity, the high yield there, probably an average of around 12.5% in the fund. And then through the development, developing to a cap rate in the future of anywhere between 5.2, 5.3, 5.4, which is a healthy margin given where current cap rates are today. So Dave, maybe you can answer this. Will there be new sidecars this year?
I don't believe so. I think the only way that would happen would be if we raised or deployed enough capital to grow the fund large enough where we could increase our allocation back to build the core, which is really where we've raised sidecars. So unless you feel otherwise, Michael, my answer to that's probably not.
Yeah, unlikely. I mean, there's always, but like always, we will communicate with investors if there's an opportunity to. And if you recall, last year is when we implemented that 20% build to core bucket. So we actually went out throughout the year and we sourced 5 opportunities to diversify the fund, and I believe each of them were right around $7, $8, $9, $10 million, and we had sidecars on all of them. So if there is room in the IncomePlus fund for another development deal, we'll bring that sidecar out to investors. I know the plan was to hold these assets forever, but with current valuations, is there an offer you can't refuse? Dave, you want to take that, or you want me to take it?
I'd love to hear your answer to this one.
So what I think about is portfolio management and construction. Is there an offer we can't refuse? Well, generally, we're not marketing our assets for sale. So the capital markets decide where valuations belong today. And I'm not, really smart enough to know, have a crystal ball and know where they're going to be in 5 or 10 years. And I'll just say that, over the last 10 years, one thing I've learned is that when you think something is expensive, just wait a year or two and it'll go up in value, especially in the multifamily or even the stock market or anything. So Look, if somebody came along and it was a 1031 exchange buyer and offered us just a ridiculous price on an asset, would we have a conversation about it? Absolutely. But it's not our strategy in this fund to be flipping assets, because what that does, it's a very tax efficient fund and designed to be tax efficient. And what we've learned is that the most wealth is created by building value early in the life cycle of an asset and then holding that asset for a long period of time, forever. Stocks, it doesn't really matter what you're talking about. So that's kind of what we look at here. And if we do look at the portfolio and we decide there's a market we no longer want to be in, or an asset that we don't want to be in, then we will utilize the 1031 exchange to be able to do that. But without marketing an asset for sale in the market, it's kind of hard to say that we're getting an offer we can't refuse. Dave, feel free to add.
No, I think that's well said. I don't have a ton to add, but I did want to jump into one of the Q&A questions that I think is pretty relevant, that other folks may also be wondering as well. But it addresses the notion of us going into Growth Fund 4 deals with prep from IncomePlus. And it says, how will IncomePlus investors know that prep deals and Growth Fund 4 projects are priced fairly, such that Growth Fund 4 investors don't benefit at the expense of IncomePlus fund investors? Great question. And I'll answer that with ultimately, we are in the market actively looking to deploy prep aggressively in third-party opportunities. So we have a really good understanding, because we're losing a lot. We're losing a lot of deals because A, we're not willing to go up to, in cases, 90% loan to cost, which we won't do. And B, we're not willing to go 10% or less on our coupon rate. And that knocks us out of most deals that we're seeing in the marketplace. So by virtue, if you recall, I mentioned previously, we're actually going to be able to benefit IncomePlus fund investors in two ways. One, we're taking on less risk substantially at loan to cost by going up to 75%. But number two, we can get coupons that you can't get an 11% coupon at 75% of the marketplace. It doesn't get, there's market forces that don't allow you to get that. We're able to get it because we control the whole stack. And what that does is that 11% piece that IncomePlus would be putting in, just as an example, it could be 11 to 12, depending on how we price it. But let's just say 12 for a second. Even at 12%, that piece of that IncomePlus prep coupon or yield is accretive to the returns that Growth Fund 4 investors are looking to achieve, because we're looking to achieve, as we said before, at the deal level, call it a 17%. So by inserting a 12% and the investors that are trying to get a 17, it juices, supercharges, my term, those returns. So it is truly a win-win for both groups. We're obtaining something that we can't get in the open market today.
Yeah, and Dave, Pierre, he's got another question too that we can answer in a second. I'll say it doesn't really make sense for us either, as we were talking about Growth Fund 4, because Growth Fund 4 has a higher leverage point. So for those of you who don't know, we run another fund. We just launched it recently. It's an opportunistic sort of a growth fund. And that has a 75% leverage component to it. And it didn't make sense for us to go out to the market, find a third-party provider for preferred equity, pay the legal cost, the transaction costs when we're sitting on money in the IncomePlus fund and we have a preferred equity bucket. And so to us, we kind of looked at this and I got comfortable with it, because one of the most important things when you're providing preferred equity is knowing the owners, understanding them, what happens when things go wrong, because you are in two different parts of the capital structure. So, the fact that we're executing on the equity side, that's what got me comfortable versus maybe a third-party developer who we didn't know that we can do that for. So it's definitely, it's a great question. It's a balancing act. We said on the Growth Fund 4, we were going to talk about it here. So thank you for the questions, and feel free to follow up if you'd like on that question as well. And Dave, Pierre has another question that maybe you want to tackle.
Yeah, how do IncomePlus investors know that Origin's maximizing pref returns by pursuing opportunities in the overall market versus a preference to Growth Fund 4 projects? And they're not mutually exclusive. I mean, we can find opportunity. We are definitely going after opportunities in the open market, and as I mentioned before, aggressively. And we are continuing to find headwinds in that marketplace because there's so much capital that's pouring in. But we know we are maximizing returns for the fund because we are not willing to go to a 10% return. For example, at 85% leverage, we can get a higher coupon with deals that we have more insight and control over. So we know it because we're in the market and we are trying to source, third-party deals first, and we have a pipeline of those, but we'll be augmenting Growth Fund 4 deals with. So the short answer is we're going after every opportunity we can find for the best risk-adjusted return in the marketplace.
Yeah. This next question is from John, and it's about John says, I'm surprised by the level of cash in the fund from month to month. It must be dilutive. Why not use your line and call capital closer when actually needed? So, John, I am going to give you sort of an inside sneak preview of what, let me see if I can do this here. Dave, what do you see here?
I see an Excel spreadsheet and your desktop.
Okay, great.
There you go. Now we're good.
How about I don't show? Okay, so John and everybody, this is really an internal sheet we use, and we meet on a weekly basis for budgeting and forecasting and looking at this. And you can see this is the IncomePlus fund. We have these for pretty much every fund we operate, because one of the challenges of operating this fund from our perspective is that money is coming in, and we have an obligation to deals that we've tied up that might be closing in 1, 2, 3 months. And so what we've done is internally, from an operational perspective, we create this cash flow forecast that includes pending deals that are that need to be closed, also preferred equity that is maturing, and then money that's coming in as well. And so what I did for this perspective, just to show you, is that this doesn't, in here, if you look in January, we have this massive influx of capital from where we are because Aspire Westminster is paying off. And Aspire Westminster is a massive deal. And so we have to spend some time putting that money out. Now, we are not going to be calling capital. We have a tranche, what we call a 12, coming around here, but you can see the amount of deals that we're closing over the next 3 months. So we do our best to manage the cash drag in the fund. And I can only tell you that when we have this much cash, this keeps all of us up at night, and we're trying to accelerate deals, but we want to manage, between just making sure that we're investing in the right deals and we're doing things. And what Dave said, when we have something like Aspire Westminster pay off early, but we're protected by a multiple floor, that actually helps us during that period, because what it's saying is that multiple floor pays off at a higher yield, so you can afford cash drag for like a month or two. It's not something we do, but it's how we manage the fund. And so we will most likely in the next tranche be calling capital here, because you can see the net cash flow projection, we finally sort of run low here. Ideally, what we'd always like to have in the fund is somewhere between 5 to 10% of capital. And that's something we're constantly managed. So I wanted to just share that with you and everybody else to get kind of an inside peek about how we're looking at this and managing it. Hopefully that's helpful. Dave, you want to take the next one?
Yeah. So we're 10 after. I just wanted to do a time check, but I can answer.
Yeah.
I can answer this quick question here. Are the 4 development deals all marked to cost in the current NAV, or has there been some appreciation? Good question. And I did cover a little bit previously on the methodology and how we go about valuing our development projects based on our methodology and based on where it sits within its development timeline. And I will say that the Morris Belmont project has not seen any appreciation because of just frankly where we're at. We just broke ground. We've got a lot of earthwork going on. We won't start vertical construction for another 7 months. So no appreciation there, but the other 3 development deals have seen some aspects of appreciation. Not a significant amount, but we've applied our methodology. In some cases, we've written up I think Linden House maybe of the investments has seen maybe slightly the most appreciation, but they've all seen some nominal level of appreciation since we closed.
Yeah. Well, thanks, Dave. I'm going to answer one more question from Gary. He's got a few here about tax efficiency in the fund, and then we'll sign off after that. Gary's question is about how do taxes work on preferreds? Are they tax efficient? And they're not as tax efficient as common equity, but they are still tax efficient in the way we structure them, because we structure them as open-ended with no maturity date. So they're not necessarily structured as debt. So when they pay off, we get the advantage of long-term capital gains. And then keep in mind that we have the REIT structure that gives you a 20% deduction on income. It's important to know that the way we structured this fund, it always was going to have preferred equity and equity together. And it's that excess depreciation that we're using. In other words, depreciation that's left over after shielding income from the common equity investments that goes to shield the preferred equity investments. So I talked about last year how only about 95% of the income was going to be tax-free. Well, some of that we had preferred equity pay off last year, and that income was then offset against the depreciation that we were holding at the REIT, and it was very tax efficient. So I would say that you can expect that level of tax efficiency going forward, but it really matters on how much depreciation we have in the fund, how many preferred equity deals pay off in a given year. Certainly, if we're overweighted preferred equity, there might be some, taxable events, could be 10, 20% of that income is taxable. But overall, we're striving to make this as tax efficient as possible. But our first priority is to putting us into good investments. So we're not going to choose a common equity over a preferred equity deal because of the tax efficiency. All right. Well, thank you. So that is, we are well over. Everybody, we appreciate your time today. If you have any further questions, please email your relationship manager. You can email us at investorrelations@origininvestments.com, and somebody will certainly get back to you. You can visit our website. Really appreciate your time today. Be healthy, be safe.